If you have a Citadel or hedge fund interview coming up, you should know that Citadel is known for asking tough technical questions on the market and fund strategy that are quite different than what you expect from a traditional investment banking interview. Today, we have Chris Ricks, one of our mentors and ex-Citadel professional, and we're going to do a mock interview with actual Citadel hedge fund interview questions submitted through the WSO interview question database. Stay tuned to learn how Chris walks through Citadel's very specific investment strategy and how he analyzes the current market. All right. Hi, Chris. Thank you for attending the mock interview with us today.
Hey, Annie. Thanks for having me. I'm really excited to be here.
Yeah, I wanted to give a quick introduction to the folks who are watching this mock interview. So Chris has a very illustrious background. He was at the ECM desk at Bank of America before going to Citadel, which is hedge fund, which is what this interview is all about. So I'm really excited to do this because now you get to hear from the perspective of someone who's actually worked in the field answering these real life questions. And you can see how he answers them and then use it to practice for your own interviews. All right. So, Chris, are you ready to get started?
I'm ready. Let's do it.
All right. And then just a little bit aside, Chris will be talking about this from the perspective of a student. So obviously not from where he's positioned right now. So, if you could rewind, Chris, to when you were a sophomore interviewing for this, that would be amazing.
Absolutely. Yeah, we'll do.
All right. So Chris, tell me a little bit more about you.
For sure. So I was born and raised in Maryland, just 30 minutes outside of Washington, D.C., where, the primary industry focus is government and consulting, and finance was rarely ever discussed. As a result, I was a pretty late bloomer to the world of finance, but I was fortunate enough to attend the University of Maryland. I chose the school because of its sheer size, right? With, you know, 25,000 students, 800 different clubs and organizations. I wanted to just immerse myself and throw myself in to every part of campus life as much as I could, and I knew I would get a diverse set of exposure to different viewpoints and learn about different fields. I had a friend in the business school who had done an investment banking internship at Goldman. I talked with him, and he put me in contact with other bankers, and just soaking up that information. That's what sparked my initial interest in finance, right? And then from there, I wanted to immerse myself as much as I could in really understanding the nuances of the financial ecosystem. So I joined our investment banking club on campus, right? And we had practitioners come in to speak with us. They taught us about the investment banking, sales and trading, hedge funds, and where they all kind of fit into the whole financial ecosystem. We learned about the day-to-day kind of roles of a banker. And then I also wanted to complement that with some technical skills, right? So I signed up for Wall Street Oasis, and I signed up for a ton of their courses, right? The program walked me through, a real intensive in modeling, right? Going through how to build a DCF, a comparable transaction or precedent transactions, comparable company analysis, how to build an LBO, and that really helped me, as I was sort of going along in my development. But ultimately, I learned that what I love about finance is that it really combines my interest in learning about kind of new themes that are impacting the world and society at large, while also kind of enabling me to deploy the capital into helping bring those companies into fruition.
Awesome. Why hedge funds?
Absolutely. So as I mentioned before, right, going through sort of that intensive and being a part of the investment banking club, we got exposure to various parts of the industry, right? Investment banking, ECM, sales and trading. And I think that a hedge fund really offers the perfect blend of all of these, right? Being a successful hedge fund analyst means having a passion, right, for deep analytical research and having a long-term view of stocks, like in investment banking, while also having to understand the short-term trading dynamics like you would, in a sales and trading role. And so for me, from a personal standpoint, I love digging into company business models, really peeling back the layer, analyzing how that company operates within the broader context of their peer group and the market overall. And I just really love and enjoy the challenge of consuming vast amounts of data and having to synthesize that and conduct due diligence. And lastly, I think, hedge funds are very unique in the sense that, it is a true meritocracy. Like, you have to not only have an opinion about the market, but you have to take your opinions and apply them and put capital and put risk on in the market, right? And the market tells you very quickly whether you're right or wrong. And so, from a broad perspective, I just think hedge funds and provide a very valuable service to the market, right? They drive forward growth and innovation, right? Companies that need capital, whether that's a early stage therapeutic company that's developing a new cancer drug, or whether it's a mature grocery store that provides an essential service, hedge funds are an active participant in providing capital for those companies to continue growing.
Awesome. I understand that you're in the middle of the recruiting process, so I imagine you're interviewing with a lot of different firms. I want to know, why are you choosing Citadel?
Absolutely. Great question. Happy to answer that. So going through my process of coffee chats, as you mentioned, and recruiting, Citadel's platform really stood out to me and resonated with me for a couple of reasons. The first is, Citadel has one of the best institutionalized training platforms on the street that I've seen. Ultimately, this is an apprenticeship business. Being able to learn while sitting next to some of the greatest thought leaders of the industry is important, but then complementing that with a very hands-on institutionalized training program is a massive differentiator for me personally. Secondly is the firm's risk management. Citadel has been able to consistently generate meaningful outperformance versus the market, regardless of different market conditions, whether the market's up or down. I think that really speaks to the risk management. Citadel's at the forefront of combining quant and systematic strategies with fundamental research. So as an analyst, you'll be able to not only be conducting your own research, but you can leverage the broader platform. You can leverage the systematic team or the quant team to understand, liquidity dynamics or how to structure your trade. So the firm makes really data-driven decisions. And then lastly, and most importantly, is culture. I really got the impression that what stands out is the emphasis on intellectual rigor and a very collegiate culture that's about learning. The best ideas really win out regardless of seniority. And I really just thrive in those types of high performance environments where I can challenge the consensus and thoughtful debate and just allow the best ideas to win out.
Great. It sounds like you've really done your research, Chris. Great answers. We're
Appreciate
going to
that.
move more towards the technical side of this
Sure.
interview. So, a lot more market-based in the technical aspects. First question for you is, can you pitch me a stock and tell me the two most important headwinds and tailwinds?
Absolutely. Absolutely. The stock I'm going to pitch is called Lineage Logistics. So just a bit of a company overview, just for context. Simply put, Lineage provides warehouses for restaurants, grocery stores, fast food chains to store their food in cold storage. They basically make money by charging these food handlers for storage space. They're currently the largest player in the market globally based on square footage of warehousing space that they have across the world. And their closest public competitor is a company called 𝗵𝗫𝗁 that comes in at a close second. So that's a little bit of a company overview. As far as the industry setup, it's very top heavy. So you essentially have two players that dominate the entire market, right? Lineage has around 21% market share. 𝗵𝗁𝗁 has around 16. And then after that, it's very fragmented. So you have hundreds of little tiny players that pop up in these kind of regional areas. And so that actually leads into your question, right? My first tailwind is that Lineage is a market share leader in a very, in an industry that's an essential service. So it's resilient to economic downturns and it has clear growth drivers and it's really hard to gain scale in the industry, right? So from, the long-term growth drivers are very clear. Just rising population leads to rising GDP, which will ultimately lead to more food consumption and more demand for cold storage. But then secondly, the scale, right? This is a very commoditized business. So their customers, right? The restaurants, the grocery stores, they're really not picky as far as which cold storage company they go with. They essentially just end up going with whoever has the warehouses that are closest to their key end markets, right? And so, Lineage isn't gonna, it's really capital intensive and time intensive for these other competitors to try to catch up. So from a revenue perspective, I think that rising GDP will add around 3 to 4% of revenue, and then price increases, which they are able to do because of their scale, will add another 3 to 4%. So I model out around 6 to 8% revenue growth. The second tailwind is the margin perspective, right? Because of the sheer size and because of all these tiny players that pop up, they can do a ton of M&A. So in the past 7 years, they've acquired 115 companies, primarily smaller competitors, and they're able to do that, right? Because again, they have the capital and they can then extend into all these regional areas where they don't already have a presence. And as they do that, they're able to make better use and more efficient use of all their factories and drive down, right, their unit economics. And so because of that, they can add around 1 to 2% of EBITDA margins. So those are the two biggest tailwinds, right? As far as my price target, just a quick little valuation. Currently, Lineage trades around 20 times EV to EBITDA in 2025, while the second largest competitor, Americold, trades at around 17 times. Lineage has 10% better margin profile. So they generate about 25% EBITDA margins versus Americold at 14%. And the bigger scale leads to more expansion opportunity. So I think it deserves more of a 24 to 25 EBITDA based on 2025. And that gives me a price target of $71, which is about a 20% upside. My downside scenario, I think it worst case scenario, maybe down 6 to 10%, but still a premium to Americold. As far as the headwinds, one is they're always kind of highly exposed to supply chain disruptions. You saw during COVID, right? As restaurant demand basically went to zero during COVID, demand for their services went down. But given the higher margin structure, they're able to sort of absorb those if they have to do cut prices, right? They're able to absorb that much better, right, than Americold or any other competitors. And then the second headwind is interest rate risk, because their strategy is very M&A heavy. They're always going to be exposed to real estate fluctuations and interest rate fluctuations. But they've mitigated that by paying down a ton of debt, right? So the debt to EBITDA is around 5.5 times. Americold is around 5.3 times, but they raised around $4 billion in their IPO, and they're using about $2 billion of that to pay down a ton of debt. So that really de-risks their model.
Okay.
And sorry, your last question, as far as how would I hedge that? So again, if you think about the risks of the business that I mentioned, right? The first is just lower demand for cold storage. So that one's easy. It's got one major public comp. So I would short Americold, so about 50% short Americold, because even in the worst case scenario, if the entire industry goes down, you would expect Americold to go down much worse, much further than Lineage, right? Just because it's not as good of a model. They don't have their hands in all these different regional areas. So, Lineage is going to provide, Americold is going to provide kind of a floor. And then secondly, I would do 50% of a short in a real estate ETF, right? Like IYR, because if there is a drawdown in terms of the warehousing real estate value, you're hedged on the real estate side as well.
Okay, excellent. Okay, so more about Citadel. So one of our core strategies is market neutral, running market neutral. So
Sure.
I want to know, how much do you know about that strategy, and what you see as the benefits of that strategy compared to other shops?
Yeah, happy to answer that. So they've done a bit of research into the platform and into the market neutral strategy. And that's really one of the major reasons why I want to work at Citadel, is because of that platform. And so just to kind of explain it, the way I think about it is hedge funds overall are trying to beat the market, right? They're trying to generate low beta returns. And by low beta, I mean, returns that are independent of the market. Because if a fund is, generating returns that mirror the S&P, then as an investor, I'm better off just investing in a low cost index rather than paying a hedge fund, 20% of my returns. So a market neutral strategy essentially attempts to generate alpha regardless of the broader market. And kind of the two key components of that are gross exposure and net exposure. If you think about net exposure, it's your long positions minus your short positions. So if I'm long 100 million and I'm short 20 million, my net exposure is 80 million, or I'm 80% net long, which means that if the market goes up 10%, I can expect to be up 8%, right? But market neutral is your longs minus your shorts equals 0. So if I'm long 100, I have to then find a correlating stock to also short so that my short is also 100 so that my market exposure is effectively 0. My book doesn't move along with the market. And in that model, the gains come from leverage, which is basically if my longs equal my shorts, I'm gaining on the leverage that I'm taking. So my gross exposure is my longs plus my shorts. If I'm long 100 and I'm short 100, my gross exposure is 200 million, meaning my leverage is 2x. So any portfolio return is magnified by 2x. And so it really encourages having to really pick the right ideas because those returns are magnified. The risk of that model is that if you're wrong, you're wrong very like much on the downside. But again, it's about picking like the right stocks and the right ideas winning out.
Okay, awesome. Very good. Okay, and then this is more about you and your investment process. So I want to learn more about how you think about investing, so your own investment process. And then, more specifically, let's say a company trades at a really high PE multiple, strong growth, but a strong growth. How would you determine if it's a buy or a short?
Sure, for sure. And I think again that's really kind of the downside of just using comps, for example, or comparables as a metric, and really the need and importance for a deep fundamental toolkit. I think as far as the checklist, right, I would maybe give an example of a stock that trades at a really high PE, right? Tesla. Right, the last that I checked, Tesla was trading at around 128 times estimated 2025 PE, which sounds crazy. And, but why does the stock keep going up? So when you compare it to, competitors, right, like the traditional automobile makers, GM, Ford, those are trading more around 5 times, 6 times PE. So it sounds even crazier. But I think there's sort of 3 things you have to look at. One, kind of what is the overall growth opportunity of the industry? And I think Tesla is in just a really unique position, right? Right now, there's an extremely small penetration of electric vehicles, right? Of the 1 billion vehicles on the road, I think only about 20 million are electric vehicles. And so they're already able to generate the revenue they're generating. Imagine if that penetration even just goes up 10, 15%, right? And people have talked about maybe we'll have a world one day where every vehicle is an electric vehicle. So one, just the massive, really rare market opportunity. Second is, PE is only, 4 and 5 for GM and Ford, and it's 128 for Tesla. But what does the growth look like? Like the fact that Tesla has premium pricing, they're the dominant player, they have more efficiency and scale. They're just growing way faster than every other competitor in the industry. Third is from a margin perspective, right? It's much higher than those traditional automobile companies, which is really impressive because GM's been around for 100 years. Tesla's been around a fraction of the time, but the fact that they've been able to build a better margin profile means they clearly have a clear advantage over those companies that leads to higher growth, better margins, and better free cash flow generation, meaning they can invest into the business and actually grow the business much faster. So I would actually argue that though the PE looks crazy in isolation, I think that it's actually, justifiable for a stock like Tesla.
Okay. Yeah, Tesla is one of our most commonly pitched stocks for that precise reason.
There you go. Tesla and NVIDIA, I would imagine, are probably like 2 very common ones.
Okay. And then final question for you is related to the market. So, what are your views on the market? Well, let's rewind. What do you feel like are the main drivers of the market? And then just given your personal view, where would you invest?
Sure. Yeah. I mean, I think we're in a really interesting, choppy time right now. I think kind of 3 of the sort of biggest, market sentiment drivers currently, in my opinion, one is monetary policy, right? I think you saw the S&P had, 2 years of 20% returns, right? In 2023 and 2024. And a lot of that in 2024 was driven by just, priced in, 3 or 4 Fed rate cuts. But after, I think December, it became clear that the Fed was going to be a lot more slower in terms of rate cuts. And I think the, dot plots went down to like maybe 1 for this year. And you saw markets really, tank in December after that. And so, I think inflation is kind of really stubborn right now. And then what does that mean for rate cuts? I think the market is really kind of taking its hints from the Fed. I think two is, new administration, which was interesting because you saw after the election, stocks got a nice bump. But I think with, tariffs coming back on the table and what's going to happen there, how does that impact company earnings? How does that impact the consumer? I think that's a really big driver and really important to watch going forward. I think that's a bit de-risked because we have had 4 years of Trump before. And so we kind of know what's going to happen. And the market did well in those 4 years. So I think that's a little bit de-risked. And I think the third is just positioning and market breadth. Something that really scares me and alarms me, as an investor is you have these really crowded trades like big tech, right? NVIDIA, Microsoft, Amazon, Google. And if you look at like the NASDAQ and the S&P's performance, like I said, 20%, gains over the last 2 years. But if you strip out those five names I just mentioned, it tells a completely different story. So the market's kind of being held up by like these five names and what happens if those turn, right? And so kind of keeping all that in mind, I would be invested in some sort of defensive cyclical type names, right? Names that tend to do well during recessionary periods, consumer staples type companies, value oriented type names. I think growth right now is tough just because there's already so much priced in to growth. How much more can you grow? I would be investing in companies that, can show really strong earnings. And I would be investing, potentially also in private credit, right? The Fed's going to lower rates eventually. And I think people are just going to be looking for yield and to diversify outside of equities. Treasuries aren't really going to get you, a ton, but private credit, I think, is kind of a nice, safe yield play there. So I would sort of have a portfolio that's, packaged with that.
Okay, excellent. Well, thank you so much for your time, Chris. I just want to wrap it up because you've now seen the interview process multiple times going through it.
Sure.
And then you've also been a very prolific mentor within the Wall Street Oasis Academy. So do you have any best practices or advice tips for students heading into the recruiting cycle, especially for hedge funds?
Absolutely. Well, I just want to thank you also, Annie, for interviewing me and for the great questions. Yeah, I mean, I think as far as best practices and things that I've noticed, I think ultimately for a hedge fund that I think kind of differs from maybe banking is, for banking, there are a set sort of list of technical questions that you'll get. I think for a hedge fund, the goal is, as conversational as possible. I think that they're not necessarily kind of running through sort of a list of specific questions, but kind of more about what are your general thoughts, picking your brain. And so I think trying to have the interview be as conversational as possible and trying to direct the interview toward names that you've researched and specific things that you have a strength in is really, really important. And part of that's done with the resume, right? So you get questions that cater, to your strengths. And then I think the other biggest part is, especially coming out of undergrad, is so much of it is because you don't have work experience or a ton of work experience yet. I think a really important part of the interview is going to be, why do you want to do this? Like, do you have the passion for this? And can you differentiate between fund XYZ and that fund over there? I think as you get a little bit older in your career, your track record speaks for itself. But at this early stage, I think you really want to perfect that why hedge fund and why this specific strategy and platform over another. Those are my two tidbits of wisdom.
Yeah, sometimes I find that the passion really comes out with the technicals. If you're passionate about
Mm,
something, you're going to study a lot into a specific company or the strategies. So sometimes the behavioral question, I mean, you could answer it in a technical way that shows the passion.
I totally agree.
Yeah.
That's great. I'm gonna take that for my mentor calls. I'm gonna
Yeah,
steal that.
and
That's
then
really good.
the other question that I hear a lot, I would
Yeah,
love your perspective on this, is,
yeah,
you mentioned in the first tip is to be conversational with an
sure.
interviewer. And a lot of students find that because there's one person asking the question and I'm answering. So what is your perspective on how you're able to be conversational, even though it's like a Q&A type of scenario?
Yeah, I mean, absolutely, right? I would say, hopefully they would be asking questions, right? Like, for instance, when you asked about the stock pitch, right? Like, hopefully they're asking questions and trying to understand and maybe trying to pick apart. But, if not, you could say something like, hey, and this is where the research and preparedness comes in beforehand of you've looked at the company, you know what their strategy is, you know what kind of names they have in their portfolio. And, you say, hey, like, I know that you hold XYZ stock, or I know that you focus on these types of companies. Kind of how do you feel maybe this fits into your portfolio, or kind of what do you think about that thought process? Things like that of if you're not getting that reciprocal energy, I think showing that you've done some research and due diligence and then asking about that kills two birds in one stone. It makes it conversational and it shows that you've done your research.
Excellent. Well, thank
Yeah,
you so much, Chris.
of course.
And yeah, thank you for all of this. And everyone who's watching, I hope you ace your interviews and learn a lot from this mock interview.
Thanks so much.